buy a few of those, buy everything else as well. So the cost of money is seen going up potentially more aggressively this year. And we're relaxed about it. We're really happy about it. In fact, so much so that we've sent industrials to record highs. We've sent consumer discretionary to record highs. We've sent materials to record highs. Every sector, bar, funnily enough, the energy sector, which is down around about 4.8% so far this year in the US, albeit after an amazing 2016, is in positive territory. 9 out of 11 sectors, actually, in total, are out in positive territory. Now, we're flat at the start trading today, but quite frankly, the odds are, I guess, that we're still going to get a rally in the States, and that's despite all the caveats that a lot of boring old fuddy-duddies like me give you about valuation, about debt, about earnings per share. You know, 18 bucks for every $1 of earnings next year. That's what you're paying now. Sounds a lot of money, isn't it? Food and drink down 0.8% at the moment. In fact, Anheuser-Busch is the biggest decline there, down 2.7%. Household goods, again, I haven't done this for a while, have I? So I'll tell you, household goods, what a comedy sector it is. Household goods, what have you got in there? You've got Pandora, you've got Hermes, you've got LVMH. Whose household is this? This must be Karen Cho's household, I tell you. Retail down 0.4%, J. Sainsbury down over 1% there as well. In positive territory, again, I'm going to hold a bit of caution on this one, because Basic Resources very often comes out of the gates really, really well in the opening rotation, and then I look at it half an hour later and it's down 0.7%. So at the moment, Basic Resources is moving into positive territory, led by the likes of Rio Tinto. Should we have a look at the European bourses? Just to give you a quick look after the really good rally yesterday. The FTSE, I think the FTSE was struggling for a long time between 7250 and 7300. And yet yesterday, boom, 115 points higher, went straight through that and is now, well, seemingly very comfortable with a high 73 handle on it as well. CAC still got to get to the 5,000 level, but the Zetrodax did mount that 12,000 level successfully yesterday, although we're seeing a little bit of early abating on some of these prices. Let's get through to some individual numbers. We're starting off on Roche, it looks like. Okay. This is great. If it works, fantastic. Basically, combining the Perjeta and Herceptin drugs with chemotherapy reduced recurrence of aggressive breast cancer or death compared with just Herceptin and chemos. This is according to Roche. And this is a very important study for them. It's the Infinity study. Now, quite apart from the fact that if it can beat or certainly have aggressive action against this most foul of cancers, then fantastic news all round as well. But it could be worth to the company as well, around about $2 billion in annual sales in 2018, hinging on this Affinity trial outcome as well, and that is why the shares are having a storming rally to the upside. So from a
bloody good in mental health, though.
Unbelievably fantastic, and if you've got Roche shareholder shares as well, well, it's good for you as well. Let's have a look at AB InBev as well. World's largest brewer, down 2.4%. It has actually raised its forecast for savings and benefits from the SAB Miller takeover as well. It's talking about a new target of cost savings of $1 billion. 1.05 actually after the initial bill, but the market just taking a little bit of time to appreciate this one as well. Of course, there's a lot of debt involved in the deal. Shares down 2.4%, 3% for the last year as well. Adecco, where have I got that one? So I'm giving to me in a funny order today. Reported better than expected earnings in its fourth quarter, saw strengthened hiring momentum across Europe. We mentioned in the headlines, didn't we? It was Southern Europe, Portugal, Spain, that were amongst the most positive. And yet we were talking to Alan De Hayes, the CEO. We were talking about a whole host of things. And Brexit, this horrible, horrible situation at the moment, where you've got this brilliant European diaspora in the UK, don't know what their legal status is. You've got this, I wouldn't have to say they're brilliant, I think most of them are retired. You've got this UK diaspora in Europe, don't know what their legal status is, and it's awful. So is this having an effect, i.e. the Brexit uncertainty, on recruiting in the UK and elsewhere? Let's listen to Alan De Hayes.
We see the first sign of the Brexit in the perm recruitment activities. There we had a minus 15% in the Q4. And we see that especially the financial services companies, mainly located in London, are in a wait and see mode.
It was good speaking to Eric Ollison, actually. We spoke to him in Davos, and actually he was on one of my panels out there as well. And the shares are up 1.8%, and that's no mean feat, because the company's doing well. It's the merged company. There's a lot of very interesting things, but you have got this investigation internal into events in Syria. And read it. Imagine what you would do in that situation if you were at that company and you were one of the managers of that plant in Syria. It's a really interesting story, actually, and it's a real moral dilemma But obviously the company's got to do the right thing in terms of code of conduct. And we spoke to Eric Ollison about this, and he seems happy that the company has done the right thing. But he's also talking about whether the company is well positioned or not to benefit from infrastructure spending in the US. Let's listen in.
We're the leading cement producer in the U.S., and we have approximately 30% available capacity due to investments that we've made in the last 3 or 4 years. So we're ideally positioned in the U.S. to be able to benefit from not only a market that's on an upward swing in general in residential, commercial, but also infrastructure investments. I think the important thing to remember about the U.S. is that yes, there's going to be, we believe, a big commitment and a big increase in infrastructure investment, but as well, the overall cycle in our industry is on the upswing, and we would expect it to continue to be that way at least for the next 3, 4, 5 years. So we as LafargeHolcim, we believe we stand to benefit very well from these investments going forward. $1 trillion of investments in infrastructure is a real commitment.
There you go, the boss of Holcim. Alex Dryden has joined us, global market strategist at JP Morgan. Good morning to you, Alex.
Morning.
Nice to see you. Let me ask you, on a valuation basis, a lot of people have worries about this market, and yet it's forcing people to take interest and participate to a certain extent. So can you have a plan and a portfolio that allows you to get involved but get out quickly if things start to slide?
I think valuations are becoming a concern, but I would caveat that with it, particularly in the US stocks, which I think where you're starting to see valuations getting a little overstretched. The S&P 500 closed last week, 17.7 times forward earnings, 11% above its long-run average. It's not a cheap index anymore. It's not as expensive as it was in the dot-com bubble. I'm not particularly concerned that you're going to see a sort of valuation-led sell-off, but you need to be wary that if you're buying an expensive index at this point. I just believe there's better opportunities elsewhere in the world. I think outside of the US, I'm particularly looking at Europe on a relative valuation basis and going, actually, this is this area of the world which is quite cheap. Choose a sector, any sector in Europe, compare it to its US or global peers, and it looks much cheaper on a valuation.
Yeah, but it looks a lot less sexy when you compare the relative performance from the beginning of the year, or indeed since Donald Trump was elected. Look, one crumb of comfort is, as you point out, there's been significant divergence now between sectors. Surely that throws up some opportunities for those who are prepared to be more active, drill below the index and have a look at individual stocks or sectors.
Yeah, it's very interesting. From a headline basis, US equities have looked very calm this year. Yesterday was the first day that the S&P 500 closed up or down 1% in 2017. That's the most tranquil start we've had to a year since 1966. However, look beneath the surface. Average stock-to-stock correlations have broken down. They're at 25%. That's the lowest since the late 1990s. So you've got an opportunity as an active fund manager to go through and try and find the stocks that are not, now that they're no longer moving in lockstep with one another. But you need to be on an active footing to take advantage of that.
So what sectors would you be long and short here?
I am still okay with financials. I still think that there is some upside. I'm looking at the deregulation potential, particularly from the new administration. I'm looking at a tax cut, thinking that that is an interesting area as well. But I'm also looking at the world going, actually, global reinflation theme, also a tighter monetary policy, yields moving higher, good for net interest rate margins for financials, but it's also good for their trading volumes as well.
That seems to be the case. How much of this do you think is China and the revaluation of, what people believe growth in China is going to be?
I think this year China is going to be relatively solid. I look at the Chinese data at the moment and I think things are going to be okay. But it's sort of like a guarantee on a dodgy car. It's valid for 12 months only. Once we get out above beyond the political events later on this year, I think they're going to have to tackle the political debt situation within China. That's going to see growth slow in 2018 and 2019. Do I think the markets are that fixated on it at the moment? Not really. I think they're more focused on the new administration and watching their first 100 days rather than being too het up on China at this point in time.
Well, what's your view on China, Lee? I mean, a lot of managers have taken a strong stance, at least on the currency, taking the view that that would be how the administration gets itself out of some of its near-term growth problems. But they've been wrong.
The reason I ask the question is because the more I talk with hedge fund analysts, the more a bunch of them have told me that the move in the American market is in many ways
Copper
tied to their
futures,
views
bellwether,
that the China
down slowly.
situation won't see a hard landing. Honestly, I can't tell you. I don't have an opinion on it. I have an opinion on a lot of things. I don't have an opinion on, which way that's going to go. I think they are hitting this kind of law of large numbers with growth, right? And you are going to see in every rapidly industrializing economy.
Okay, gotta go.